Wall Street, here are a look at the numbers. The Dow closed down 224 points. The S&P and the NASDAQ both down, and the indices both down more than 3% just for the week. So for more on how the ups and downs of the stock market are impacting your household, we're joined by Ryan Decker from North Central College. Dr. Decker, thanks for being with us tonight. Inflation, the war on Ukraine, what do you think has the market so spooked at such a sustained level here?
Yeah, I mean, there's a lot of uncertainty right now with the war, with rising gas prices, with rising interest rates, with COVID shutdowns internationally and supply chain interruptions. There's a lot of uncertainty, and investors don't like uncertainty. So what we're seeing a lot is a lot of people thinking that it's going to drop even further, so they're selling now in hopes that they'll get in lower, but that's kind of a self-fulfilling prophecy to cause the markets to continue to drop.
Yeah, it's, feel kind of like dark times right now. And you think about retirement. What is your thoughts or advice that you might have for somebody who, is in the market, is working right now in the workforce, but maybe compared to someone who is going to be retiring in the near term, I don't know, say 6 months? What do you say to each of those two Americans?
Yeah, first of all, understand that you can't control what the stock market does. But so focus on what you do have control over. You do have control over your spending. You do have control over the risk that you're taking in the markets. So if you look at the markets in the past few months and see them drop by 20%, and that keeps you up at night, well, you shouldn't be that invested in stocks. You should think about your conservative allocation in bonds and fixed income. If you are close to retirement age, hopefully you can live off of some Social Security. If you're at Social Security age, you can take that early in retirement to let some of this money continue to grow in the markets. Now, we might be entering bear market territory, but keep in mind that on average throughout our history, bear markets have only lasted a little over 1 year, while bull markets on average last for 10 plus years. And we're just coming out of a long 10 plus year bull run. So stock prices have driven up. Your portfolios have seen a rapid increase over the past 10 years. This is potentially a natural correction for that. But focus on what you can control over and focus on your asset allocation on the risks that you're taking with your investments.
Getting close to that bear market, do you fear that we are headed into a recession?
Now, difference between those bear market is stock prices dropping. A recession is a slow economic growth and really negative economic growth measured by GDP. They're not always directly linked, but oftentimes they are. But we're very likely heading into bear market territory. If you look at the NASDAQ, tech-heavy stocks, they're already there. The S&P 500, the overall stock market is nearly approaching down 20%. And if it stays like that for a prolonged period of time, we're going to be in the bear market. On the flip side, when you talk about a recession, I mean, it's really 2 quarters of negative GDP growth. We've already had that for the first part of 2022, and signs are pointing that we're going to see it again moving forward with high interest rates and continued COVID shutdowns internationally with supply chain issues. So I wouldn't be surprised if we enter into another recession, but again, focus on what you can control. Do you have an adequate savings account? Can you pay down some high interest rate debt right now?
You just mentioned the interest rates. Just a few seconds left. Have the interest rate hikes helped at all? And do you see prices finally starting to come down in the near term?
No, now the Fed only has so much control over prices. Now they are impacting the money supply. However, with supply chain shortages, we're still seeing, and the rising price of oil, we're still seeing prices increase due to all those other factors. So unfortunately, we probably aren't seeing the end of high prices moving forward, which also means we're not going to see the end of interest rate hikes. So while interest rates are going to continue to increase, if you have a money market account, or if you're investing in bonds, you should see a higher rate of interest return on those investments as well.
On that note, we'll say thank you, Ryan Decker at North Central College. Great good thoughts tonight. Thank you.
Thank you.
Take care.
Now with Tom. Hey, Tom.